Did you know that central banks around the globe sold a record $120 billion in U.S. Treasuries last year, a clear signal of growing international unease with the dollar's long-standing dominance? This isn't just abstract geopolitics, it's a direct threat to your purchasing power. By the end of this video, you'll understand the real forces challenging the US dollar, how this seismic shift is already impacting your savings and investments, and crucially, concrete strategies you can implement right now to protect your wealth and even thrive in this evolving financial landscape. For decades, the US dollar has reigned supreme as the world's reserve currency. Roughly 88% of all foreign exchange transactions involve the dollar, and nearly 60% of global foreign exchange reserves are held in dollar-denominated assets. It's been the bedrock of international trade, especially for commodities like oil. But this unchallenged status is beginning to show cracks, not just on the fringes, but in significant bilateral agreements. Consider the recent move by Saudi Arabia, a key OPEC nation, exploring non-dollar sales for its oil, or the BRICS nations actively developing alternative trade settlement systems. China and Brazil are now settling trade in yuan, and India is paying for Russian oil in dirhams and rupees. These aren't isolated incidents, they represent a coordinated effort to reduce reliance on the dollar, shrinking its demand on the global stage. But what's actually fueling this shift, and why should you care beyond the headlines? The primary drivers are twofold: unprecedented government spending and the resulting expansion of the money supply. Since late 2019, the M2 money supply surged by over 40%, effectively printing trillions of new dollars into existence. Simultaneously, the U.S. national debt has ballooned past $34 trillion, a figure that continues to climb at an alarming rate, adding over $1 trillion in just 3 months at one point last year. Imagine a company that constantly issues new shares without increasing its underlying value. The existing shares inevitably lose their worth. The same principle applies to currency. When the supply of dollars dramatically increases faster than economic output, each dollar you hold inherently buys less. This isn't just a theory, we felt its bite directly when inflation peaked at 9.1% in June 2022, eroding your purchasing power at an unprecedented pace. So, if the dollar is losing its grip, what does that mean for your investments and the cash you hold? Your cash, sitting in a savings account earning 1% interest while inflation hovers at 3 to 4%, is losing real value every single day. This inflation tax is a silent thief, effectively reducing your $100,000 savings account to $96,000 in purchasing power within a year, even if the nominal number stays the same. For investments, traditional assets like long-term bonds, which are highly sensitive to interest rate changes driven by inflation, can see significant capital depreciation. Even equity markets, while offering some inflation hedge in the long run, become volatile as the Federal Reserve is forced to hike rates to combat dollar devaluation, making borrowing more expensive for businesses and consumers alike. Your diversified portfolio might not be as protected as you think if it's overwhelmingly denominated in a weakening currency. But it's not all doom and gloom. There are proactive steps you can take right now to safeguard your financial future. The key is diversification beyond traditional dollar-denominated assets. First, consider real assets. Real estate, for instance, especially income-producing properties, often acts as an inflation hedge because rents and property values tend to rise with the cost of living. Commodities like gold and silver have historically preserved wealth during periods of currency devaluation, with gold experiencing significant gains during inflationary decades like the 1970s and early 2000s. Secondly, look at international exposure. Investing in global equities through broad market ETFs like VXUS, or even exploring companies based in economies with stronger fiscal discipline, can provide a buffer. These investments are denominated in other currencies or derive their earnings from diverse global markets, reducing your singular reliance on the US dollar's strength. Thirdly, focus on income-generating assets that can keep pace with inflation. This includes high-quality dividend stocks, certain master limited partnerships, MLPs, or even private credit opportunities that offer higher yields. Lastly, aggressively tackle high-interest debt. As interest rates rise to combat inflation, carrying significant credit card debt or variable rate loans becomes an even greater burden, effectively shrinking your disposable income. While these strategies offer a path forward, there's one overarching truth that ties all this together. The US dollar crisis isn't just about the value of a single currency, it's a reflection of a fundamental shift in the global economic order. Just as the British pound eventually ceded its reserve currency status in the mid-20th century, the dollar's role is not immutable. Your financial future isn't determined by the whims of a single currency, but by your ability to understand these macro shifts and adapt your financial strategy accordingly. To dive deeper into how specific real assets like gold and silver perform during periods of high inflation and currency instability, watch my next video on investing in precious metals, a true inflation hedge.